So we're going to do a discounted cash flow on SPG, and that's Simon Property Group. And that company is a REIT, Real Estate Investment Trust. If you don't know what a REIT is, it's a company that owns residential and commercial real estate, and they rent it out or lease it out to people or companies, and they collect the revenue from those leases or rents and distribute it to shareholders. And REITs trade on the stock exchange. They tend to be good stocks if you want high dividends. Now, the DCF model I just have to input everything in yellow. So to get the shares outstanding, I pretty much get everything from Yahoo Finance because it's all there and it's a lot faster than going through the 10K. So I see their market cap is 15 billion. So I'm going to divide it by the stock price. And the stock price is 51.32. So if you take the 15 billion, which I did here, and you divide it by the stock price, that's how many shares outstanding. 306 million shares outstanding. And down here, market cap, you can just double check. It says 15,685 because everything's in millions. So I did it correctly. And we need that because when we calculate the future value of the company, we need to divide that number by the total shares outstanding to get our calculated stock price. So now let's go to free cash flow. And it's so nice because they list free cash flow in Yahoo Finance. Everything's in thousands. So that's 2 billion, not 2 million. So I just add 3 zeros. Because I used to have to go through the 10K, and then to get the free cash flow, you have to do cash flow from operations minus capital expenditures. Now I can just take this one number. It's nice, but if you want to learn about this stuff, it's probably better if you actually do it as much as you can, because you learn a lot more than just picking numbers. Because you might take the number and somehow put it in the wrong place, or the number may be wrong. I've seen incorrect numbers on Yahoo Finance, and you can't really identify it if you don't really understand it that well. So next we need net income. And this seems like a good company to do a discounted cash flow model because they have positive numbers. Newer companies or growth companies tend to have a lot of negative numbers because they're investing so much money. So the stock price comes out negative. So obviously a DCF model doesn't work on those types of companies. But in this company, we might get a good value. And then net income for 2019. You see the years up there. And everything's calculated, so I don't have to redo it. But I'm happy to go through the model if anybody had questions in the comments, or some videos I'll try to explain more if I can. I may go through the 10K if something is missing in Yahoo Finance. And also after I do this, if I'm interested in investing in this company, I'm not going to just rely on my cash flow model. I'm probably going to look at other things too. This is just one tool to value a company. There's a lot of other things you have to do. So more yellow down here. So I usually just eyeball it to make sure it looks correct. Because if this was like, if this had like a 5 in this cell right here, I probably would double check, make sure I didn't like paste it wrong or take it from the wrong place. But it all looks correct. And I may double check at the end if my value is way off. Sometimes I get like these crazy valuations. So interest expense, that's the interest on the debt. And that can be found in the income statement. And conveniently, it's right here. The last video I did on Square, it wasn't in Yahoo Finance, so I had to go to the 10K. Short-term debt. Short-term debt is debt that's due within 1 year. Or current debt, they call it. So this is what they owe, and they have to pay it within 1 year. And then non-current or long-term debt is debt that's due beyond a year. So it might be due in 5 or 10 or 20 years. And we could find, of course, all that information in the 10K, which is also valuable to know. If you're investing in a company, if the debt is due in a year or two, companies like JCPenney's, like who filed bankruptcy this week, they probably had a lot of debt due, they missed their interest payments, and they're forced into bankruptcy. That's generally how you're forced into bankruptcy, if you can't pay your debt. But you can see the 3.4% right here. That's the interest they're paying on their debt. I should interest on debt. Make it clearer. And that looks correct. That sounds like a correct percentage. If that was like 70%, I would know something's not right. Or if that was like 0.1%. And it's interesting to see this company, Simon Property Group, their capital structure is 60% debt, 40% equity. So generally, the more debt, the lower your WACC is, your discount rate, because debt is a lot cheaper than equity, as you can see, especially in times like this when interest rates are so low. It's a lot cheaper to fund your company with debt. Why doesn't everybody fund it with debt? Well, that's a long answer, but that could be really a risky proposition. So income before tax. Now that's on the income statement. No, let's go to the income statement. Income before tax. Okay, let me make sure I'm taking, 2019. Because sometimes I've taken the TTM, trailing 12 months, which is usually the same, but not always. So let me take 2019, so everything consistent, income before tax. Income tax expense. It used to take me a half hour to go through 10K to do all this stuff. Now it's so this looks weird because they pay hardly any taxes. They pay $30 million on $2.4 billion of income. Why is tax rate so low? And let me know in the comments, but I'm guessing that they distribute, I know REITs have to distribute 90% of their income, taxable income, to shareholders. Like they can't keep it. Most companies keep the money and use it to grow the business, but REITs generally distribute most out in dividends. So they probably have a low tax rate because they don't keep much of the money. Most of it is given back to the shareholders. But let me know in the comments if that's incorrect. I'm not a REIT expert. Now, beta is the volatility of the stock. And 1.4. That just means when the market as a whole goes up $1, this REIT would go up $1.40, and if the market goes down $1, this REIT would go down $1.40. And of course, if it goes up $2, it would go up $2.80. So it's just a volatility. Beta is volatility. So the CAPM, capital asset pricing model, is 13%. Let's see if I can show you the formula. So E35, which is the risk-free rate, which I just hard-coded at 2.32%, which is roughly the 10-year U.S. Treasury rate. And I'll update it if it changes, or but it shouldn't change too much. I think I put that in last week or 2 weeks ago. So it takes the risk-free rate plus this whole thing in parentheses. So E36, which is beta, your volatility of the stock, times the average market return minus the risk-free rate. So, and the average return, once again, I just put a hard-coded 10%. That's the average return of the S&P. And you could obviously maneuver these numbers to get a different value. Sometimes you want to be conservative on these models. So you can see the cost of equity is 13%, a lot more than the cost of debt, which is 3%. So the WACC, the weighted average cost of capital, is 7.2%. So there's more debt, so it's going to weight it a little further towards the 3.4 than the 13. So it's 7.2%. That's your discount rate. That's what you have to discount your cash flows at. And you can see, based on the numbers, this is definitely a stock you should buy if you trust a discounted cash flow model. It's saying the stock is worth $201 and it's trading at $51, so it's trading at a 75% discount. Now there's other things to look at. You can argue certain sectors don't work well for discounted cash flow models. That's a different story. But in this exercise, it's a strong buy. Let me know in the comments if you have any questions. Thanks for watching.